Have you ever wondered what it would be like to collect monthly passive cash flow from real estate without ever dealing with a tenant? Or what about flipping real estate without any rehabs or contractors? I'm Susan Elliott with Flow State Investing, and in this video, I'm going to teach you how you can invest in real estate secured notes or mortgages, a little known secret in the world of real estate investing that allows you to ditch the tenants, mitigate risk, and amplify your returns. Ready? Let's jump in. You're probably familiar with the traditional real estate investing model, owning a house and renting it out to tenants. That's how most real estate investors get their feet wet in real estate. Sometimes they'll flip a house or even buy a duplex to explore ways to grow their real estate investing portfolio. We began that way, first with house hacking, then long-term and short-term rentals. But like us, you're probably also familiar with the headache of managing real estate properties. The burst pipes, the tenant screening, the broken fridge. We certainly are. Yet, behind each of these rentals is an opportunity to grow your wealth without having to deal with a single tenant. And that is the note. You might think of the note as the mortgage. But before I dive into explaining what a note is and how investing in one works, know that we meet people all the time who don't understand the world of notes. It's pretty common, even with experienced real estate investors. It's kind of a tricky subject to wrap your head around, but it's worth it, so stick with me. Owning the note typically involves a short to medium-term investment with higher returns and no calls from tenants. Risk is mitigated in multiple ways, like through an extensive and extreme due diligence process, as well as through immediate equity in the deal. And your investment is secured by the actual property. The best part is that this strategy has the potential to help keep people in their homes. But I'm getting ahead of myself. First, let's start with the basics of what exactly is a note. Then we'll cover how it works to grow your money in real estate secured notes without being an expert and without much of your time. Finally, I'll tell you more about risk mitigation, projected returns, and how note investing can actually help keep people from losing their homes. Okay, first things first, what is a note? A note is a promise to repay a loan. It's a document. If you've ever lent someone money, maybe $20 for lunch, then you've owned a note. It was likely informal, with terms like, pay me back tomorrow. But if you've ever owned a car or financed a car, then you've been on the borrower end of a note. You've promised to repay the owner of the car over a certain number of months or years at a specified interest rate. This is a note. In real estate investing, the note is created when the house is sold. We often see this as the mortgage or deed of trust. In fact, the mortgage is what attaches the promissory note or the paper to the asset or the house. Think of the mortgage as the glue that binds the loan to the collateral. A promissory note and a mortgage or deed of trust make up every real estate secured note. While the promissory note states the terms of the loan, like the balance amount, down payment amount, interest rate, and term, the mortgage or deed of trust attaches the real property or asset to that promissory note as collateral. So the mortgage secures the loan with the asset, and together they are the note. You're probably familiar with this scenario. You're ready to buy a home. You have 20% down payment, let's say $25,000, and a bank lends you the $100,000 or 80% so that you can pay the seller 100% of the agreed upon price for the house, or $125,000 in this case. The bank creates the loan documents and the note or the paper and becomes the note holder. Then you, the borrower, make monthly payments back to the bank to repay the $100,000 you borrowed at, let's say, 5% interest over a term of 30 years. You're happy because you didn't have to come up with 100% of the asking price. But the bank is even happier. They're getting a better deal. The bank has a monthly income stream that is secured by the asset or the house. Meaning, if you stop paying, the bank can take 100% of the house, not just the 80% that they lent you. Did you catch that? The bank's risk is immediately mitigated because they have only lent out 80% of the house's value, but have a claim on 100% of the asset as collateral until the note is paid in full. This is so important. Having security is what makes lending in real estate such a good investment. We protect our investment with a mortgage or deed of trust. So, notes are the paper side of real estate, and the house is the safety net for that investment. Let's dive into two main types of notes, performing and non-performing. Here at Flow State Investing, we specifically look for non-performing notes. That may sound scary at first. Non-performing, wouldn't you want to put your money into something that is performing? But this is the little known secret of real estate investing. Let's dig a little deeper here. A performing note is one where the borrower is current with their payments, and a non-performing note is one where the borrower has defaulted or stopped making payments. When we invest in a non-performing note, we pay an even steeper discount for the note, which means more equity right out of the gate. We then have the opportunity to work with the distressed homeowner to get them back on track with payments and keep their home. This is our preferred exit strategy. Rather than move directly to foreclosure, as many larger lending institutions might, we work with homeowners to create new terms that they can afford and that also provide the highest returns for our partnership. And remember, we always have the actual house as collateral in case we need to alter or pursue one of the other many exit strategies. Ideally, we've helped keep someone in their home, and now we have a performing note, which is worth a lot more than what we paid for it. We're basically rehabbing paper here. Now, we can collect monthly cash flow off the note through interest, or sell it at a much higher value than we paid for it. Did you ever think that a piece of paper could be a cash flowing asset? It's pretty incredible. Now that we've gone over what a note is, let's dive into how it works to purchase a note. We'll also dig deeper into how risk is mitigated. First off, there are two parties that come together to purchase a note. The operators like us here at Flow State Investing, and the capital partners, someone like you. These two parties create and join an entity, usually an LLC, that holds the note. Technically, this is not an investment, but rather a partnership. This is because under that entity, all parties play an active role. But let's look at what it means in more detail so we don't confuse active with lots and lots of time. Purchasing a note requires a ridiculous amount of specialized due diligence before even making an offer. This involves reviewing recorded documents, tax payment history, legal actions, servicer comments, market analysis, neighborhood screening, current market value estimates, and much more. Operators build teams to have local boots on the ground, legal guidance, and borrower communication that make all of this possible. Don't worry. These tasks are all performed by the operator and presented to you as the capital partner for review. It is incredibly important that you partner with an experienced and educated team who knows what to look for here. The due diligence process is the first and most important way to mitigate risk. By having a clear picture of the market, the asset value, and the borrower's history, and the quality of the documentation, an offer can be made that provides enough equity cushion to make a number of exit strategies viable. So, essentially, operators do all of the legwork of finding and vetting the note, negotiating a purchase price, and creating the business plan. Then, they bring this information to you as the partner for review. After all partners agree to purchase, the operators move forward with the business plan. When a key decision point is reached, all partners in the deal come together to make that decision. This is typically a quick phone meeting where operators present all of the details. This step allows all parties to remain active in the purchase and management of the note without putting in equal amounts of time and effort. As a capital partner, most of your work is upfront in vetting the operator. Then, after the partnership begins, you'll occasionally provide input at those key decision points. No fixing leaky roofs, no calls from troublesome tenants, and no management of property managers. Okay, that's how a note purchase works. Just a few more details here on returns, capital hold time, and how much money most people put into notes. Notes provide returns through monthly cash flow or when the note is resold. All partners split these profits. Notes are short to medium-term investments as compared to other real estate investing strategies. You could expect your money to be tied up in a note purchase for about 2 to 3 years, sometimes less, but it is always better to assume the longer time frame. Even though notes are a shorter-term investment than, say, a rental property or a multifamily syndication, you should always expect to have your money in the deal for several years. Typically, note returns are slightly better than those seen in hard money lending, or about 10 to 15% total annualized return on your money. And this depends on the exit strategy used. We aim to have all notes reperform, since that is the best scenario for all parties, and since they often lead to the highest returns. It doesn't happen every time, but with thorough due diligence and a number of other exit strategies will yield similar returns. We often get asked, how much money can I put into a note purchase? Most operators offer partnerships with a minimum of $50,000. Notes can be purchased for cheaper, but we found that lower priced assets yield lower returns. And please, if you only have $50,000, don't invest it in a single place like a note. You should first focus on having things like an emergency fund, savings, and an overall investment strategy. Once a capital partner understands the process and has built a relationship with an operator, they often increase the capital amount so that notes can be purchased in bundles, up to $250,000, for example. Now, I hope I've made it clear that notes are great for putting money into real estate without the hassles of being a landlord or managing properties. They also provide nearly passive cash flow so that you can stop trading your time for money. They also are great for diversification, since you don't need to take time to build up your own team, to look at properties or manage tenants, and you can still have your money in different markets across the country. Notes are also great for amplifying your returns. And by this I mean taking your money and growing it quickly. It's also good to remember that money made through note returns is generally considered income for tax purposes. For this reason, using a tax-deferred retirement account is a fantastic way to grow your money with notes. You'll need to roll it over into a self-directed retirement account, which we've found to be a quick and easy process. Finally, I want to stress the importance of finding a good operator team to work with. Anyone can make a note investment look good on paper. You really need to dig into the operator's track record and business plan to be sure that they are mitigating risk and that they're able to do the things that they say they're going to do. There it is. Now, you know what a real estate secured note is, how investing money in notes works, and whether a note may be a good way for you to grow your money and stop trading your time for money. You should also have an idea of projected returns that you can expect and some things to watch out for. We've chosen note investing as our favorite wealth building strategy. We can mitigate risk by purchasing assets for pennies on the dollar and take advantage of many different exit strategies. But what really brings it home for us is that our money is helping people stay in their homes. We can intervene where the big banks would simply move towards foreclosures. We can set new terms and help the borrower get back on track with payments. They keep their home, and we still get incredible returns with less risk. Everyone wins. Well, I hope this video has answered a lot of your big questions about real estate secured notes. I'm guessing, however, that you have a lot more to ask. Please comment below with any questions that may have come up during this video. Also, be sure to apply to be a member of our Flow State Investor Circle. The link is in the description below. It's free to join and will give you access to more education and information about growing your money through notes. We'll schedule a call to discuss your investing goals and whether a note partnership may be the right fit for you. Please like this video and subscribe to our channel if this video has provided any value. And please share this with someone who you know wants to stop trading their time for money. I'm Susan Elliott with Flow State Investing. Thank you so much for letting me share this topic that gets me so excited. I'll see you next time.